Hey everyone, today I'm going to be ranking the largest middle market private equity firms in the world. And unlike mega fund private equity shops, these firms usually have assets under management or flagship funds under $15 billion and usually work on smaller deals, anywhere from the lower middle market around 50 million up to a billion or even a few $1 billion. But with that said, I'm not going to go too much into the differences between the two because I have an entire separate video about it. Also, I ranked the top mega fund private equity firms in a separate video, so you can check that out as well. And similar to that video, today the way I'm going to rank the firms are across three categories. First is fundraising. How much fundraising momentum does the company have? That's a good indication of how much investors currently trust them to put their money into their funds. Second, I'm going to be looking at their recent returns based off of IRR, based on the information that I could find. And then lastly, on their overall kind of reputation and general sentiment based off of what is happening with the firm lately. So I'm going to give a total score of 5 for each of these categories for a total potential score of 15, and then rank the firms based on these categories. Now, before we go into the rankings, if you're watching this video because you're interested in breaking into private equity, I highly recommend you check out the Private Equity Investing Certificate program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America Private Equity at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. The program runs 3 times a year, so you can sign up throughout the entire year, but be sure to use my code rareliquid to get up to $500 off, and I'll leave information about the program and everything I just discussed in this video's description. Okay, with that said, let's jump into the rankings. We're going to be going into each of the firms in alphabetical order that I've listed here. And first off, we have Berkshire Partners, which I'm going to put in the B tier. And Berkshire is a Boston-based private equity firm. They cover various different sectors and have a generalist approach for their associates, which is different from a lot of other private equity firms that specialize in one sector. And they're generally known for their long-term partnership-oriented approach. They recently raised a $7.8 billion fund in 2024, which was the largest in the firm's history and was oversubscribed so a lot of really good fundraising momentum, but I'm giving them a 3 for their fundraising because it's not as large as the other firms on the list. And then in terms of their IRR and recent performance, I'm going to give them a 3 as well. They recently returned about 7.7% IRR from their 2021 fund. But as we go throughout this entire video, I'm not going to place too much emphasis on recent funds because it takes at least 5+ years for a fund to actually provide more returns that you can actually rely on and think are accurate, because it takes a long time to actually invest, build up companies, and sell them for a decent return. But what is notable is that Berkshire Partners used to have top tier returns, but now the sentiment is kind of that the returns are just kind of okay. So I gave them a 3. And then for their overall reputation, I give them a 4. So they're known for having really, really great culture, and they have a strong legacy name in the private equity space, but they're not growing as fast as a lot of the up and coming middle market firms that we're going to be discussing today. So they get a total score of 10 and they're in the B tier. We next have Clearlake, which I'm going to put in the C tier. And there's a lot happening with this firm right now. So this firm is based in Santa Monica, focuses on tech, industrials, and consumer, and uses an OPS, Operations, People, and Strategy framework. Typically also works on very, very complex deals. For fundraising, I gave them a 4. They're seeking $15 billion, which is pretty much mega fund status. And the only reason I give them a 4 instead of a 5, though, is because they may be having issues with their fundraising process, allegedly. And so I knocked it down from a 5 to a 4. And then when it comes to the returns, I give them a 3. So they typically have had historically really strong returns. HEC, which has a rankings for private equity returns, ranked them number 5, but their latest fund is likely in a lot of trouble. And so let me go into kind of sentiment and reputation, which I gave them a 1, which I know is pretty harsh. But Right now, the sentiment is not great. People are saying that they have over $10 billion of distressed debt on their portfolio companies. And they have also had a good number of high profile bankruptcies. And so people consider it, in a sense, kind of like a low tier tech PE fund. And they've been raising a lot of continuation vehicles, which are funds that allow PE firms to hold onto struggling assets in the hope that performance recovers. And so right now, because sentiment is really not great, fundraising may not go super well. Of course, if the firm is able to somehow turn things around, then it could deserve a much higher ranking. But right now, they get a score of 8, and so I put them in the C tier. Next up, we have Francisco Partners, which I'm going to put in the A tier. Francisco, as you may have guessed, is founded and based in San Francisco. The founder used to work at TPG's tech group and then left to start his own tech-focused PE firm. And the company is very operationally focused and excels in carve-outs, which is where you're literally carving out a piece of a larger corporation or company, and then you're operating on its own, and also works on a lot of complex transactions. The firm recently raised in 2022 a $13.5 billion fund. I'm giving it a 4 out of 5 for fundraising, giving out 5 for those who raise about 15 billion or more. And then in terms of performance, I also gave it a 5. Very, very strong track record overall, and number 1 best returning over the past 10 years, according to an HEC Dow Jones ranking, which is not the end all be all, but was one thing that I felt like I could point to. Consistently returns over its past few funds above a 20% net IRR, which is just very solid. And then when it comes to overall reputation, I gave it a 4. The firm is very reputable, especially in tech, but not exactly a household name overall. If you tell most people not in finance about the firm, then people pretty much don't know about it. And the comp is also not that great and is known to be a very sweaty firm in terms of working its associates extremely hard. And so that's why overall I gave it a 4. In total, the firm gets a score of 13, so it's in the A tier. Next, we have Genstar, which I am also putting in the A tier. So Genstar is based also in San Francisco, and they invest in various sectors and has a generalist model for associates, which gives broad exposure across industries. So if that's what you're interested in, then this could be a good firm for you. The firm raised $12.6 billion in 2023, which was about $2.5 billion larger than their previous fund. So a lot of good fundraising momentum. But I still give them a 4 because their fund is not as large as some of the others on the list. In terms of performance, I gave them a 5. They're known for having very consistent top tier returns, and 2 of their more recent funds returned above 30% net IRR. So just really, really solid returns. And in terms of overall reputation, I give it a 4. The company and firm is known for its rare kind of anti-hardo culture, as much as you can get that in private equity and finance. And there are a lot of senior private equity investors in the firm who were previous associates, which are just really indicative of really good culture. And the firm is also known for having pretty lean teams with one of the best AUM to IP ratios. So AUM is assets under management to investment professionals. And so this just means that as the firm is scaling up, it's not necessarily increasing its number of investors, which means that there are more profits to share across everyone, and also that the firm is staying very, very lean. So that's why I gave the firm a total score of 13, and that's why Genstar is in the A tier. Next on the list is GTCR, which I'm going to put in the B tier. And GTCR is based in Chicago and employs what they call the leaders strategy to partner with exceptional management teams across various sectors to drive growth. And so they really have a management first approach, though I will say that a lot of private equity firms kind of say that, but GTCR kind of makes that really, really core to its strategy. The firm raised $11.5 billion in 2023, and they exceeded their initial target of $9 billion by $2 billion. So that's great. So I gave them a score of 4. And then next, for their returns and performance, I gave them a 4 as well. Very, very strong returns overall and very creative in general as a private equity firm in terms of structuring their deals. That's what they're kind of known for. They returned about 18% from their 2020 fund, and then 23% from their Fund 7. And so pretty strong returns overall. And then for their reputation, I gave them a 3 because they're not super, super well known. Of course, they are in the private equity world, but still brand name and legacy just not as strong. And they're also known to be a very sweaty shop, but they do have a very good trajectory, things given that fundraising has gone very well. So in total, I gave them a score of 11. And so that's why they're put in the B tier. Next on the list, we have HIG, which I am putting in the B tier as well. HIG is based in Miami, and they're known to be a value-oriented shop that looks at underperforming businesses to create value and is bringing the mega fund platform approach to middle market in terms of being flexible across deal types, so buyouts, distressed, growth. And they also have a very, very strong global footprint. Their recent fund is 5.5 billion, which they raised in 2023. They exceeded their original target, and given their strategy of targeting smaller companies, they don't need to raise as much. But given that their fund is smaller than the other ones on the list, I gave them a 3 for fundraising. And then for performance, I gave them a 5 because they have a historically really strong track record and great returns that justify a reportedly 2+25 fee structure as opposed to a 2+20. And their fund 2, for example, returned a net IRR of 26%. Next, for reputation, I gave them a 4. They have a strong reputation for being one of the top value-oriented private equity shops. They're extremely sweaty and known to be really, really annoying during diligence, where they ask for a ton of things and also end up kind of lowballing a lot of companies in processes to the point that sometimes they get kicked out of them. But it means that they're very, very disciplined and care a lot about the details, and that's how they've been so consistent in generating their returns. So overall, I gave them a total score of 12, and so that's why they're in the B tier. Now, I have a pretty fun one, L. Catterton, which I'm going to put in the C tier. And L. Catterton is based in Greenwich, Connecticut. It's a consumer retail focused firm and has invested in popular brands like Solidcore, Birkenstock. It also merged with Bernard Arnault's family office and LVMH in 2016 to go from Catterton to L. Catterton. So just a strong player in consumer private equity. It's raising $6.5 billion, and it has also had a lengthy multi-year fundraising process. So likely things are not going super, super well. Usually if fundraising windows are very, very short, then that means there's a ton of investor demand. But if it's going on for multiple years, then probably not going super well. So I gave the firm a 2 for fundraising. And then in terms of performance, also a 2, given that just in the consumer retail industry or consumer industry, it's pretty tough to generate really strong returns. They've generated about 13% from their 2016 fund and 11% in 2012, which is not very strong compared to the other firms in the list. And overall for reputation though, I gave them a 4. They're very well respected, and consumer retail is just really, really tough to perform well in, but they do have one of the most recognizable names. And so they get a total score of 8, which puts them in the C tier. Next on the list, we have Leonard Green, which I'm putting in the A tier. They're based in Los Angeles, and they're more of a growth-oriented firm where they're willing to pay higher multiples for quality businesses. And they're known for their expertise in consumer and retail. They raised $14.7 billion in 2023. So I gave them for fundraising a 5 because that's pretty much about $15 billion, kind of like mega fund status. In terms of IRR, generally pretty solid. Their fund 9 returned 32%, fund 8, 12%, fund 7, 20%. So pretty solid. And so I gave them a 4. And then in terms of reputation, I gave them a 4. They recently had an amazing exit in 2024 for their sale of SRS distribution to Home Depot, which likely is what is leading to good fundraising momentum. They also have a really good culture, and they're known to be a little bit more chill, probably since they're in Los Angeles. And so overall, they have a really great reputation. So that's why I give them a 4. And so with a total score of 13, they land in the A tier. Next up on the list, we have Madison Dearborn Partners, which is the first firm in the D tier. And let me be clear that just because it's in the D tier doesn't mean it's a bad firm. All the companies that we are discussing today are really, really great offers, but I do just have to rank them based on the criteria that I have. But anyway, Madison Dearborn is based in Chicago. It's known for its disciplined, research-driven approach, and especially has a stronger track record in tech and healthcare. Another very interesting aspect about the firm is that it's known to be very old school and a kind of buttoned up white shoe hierarchical culture. And so if that's not really what you're looking for, then maybe something to consider. It's in the process of raising a $3 billion fund, which is the smallest ever. And so I gave fundraising for them a 1. And then in terms of returns, they haven't been super great since the great financial crisis in 2008. So I gave them a 2. And then in terms of overall sentiment, I gave them a 2 as well. They have a really strong legacy brand as one of Chicago's first private equity shops. But right now they're going through a reset with a coup against leadership that has been there for decades. And so that downsizing of fundraising plus not really having strong leadership and very uncertain future. That's the reason I gave them a 2. Total score of 5, so they land in the D tier. Next up on the list, we have New Mountain Capital, which we're going to put in the A tier. And New Mountain is based in New York, does business and does both growth investments and buyouts, and is known for its business building strategy and focuses on building great businesses with slightly less leverage compared to a lot of other firms. For fundraising, they raised $15.4 billion in 2024, the largest in the firm's history. The fund was oversubscribed. And so since the fund is so large, I gave them a 5 for fundraising. For returns, they're a little bit of a newer firm, but they do have strong returns. Their 2020 fund 6, around 18% IRR, 2017 fund 28%. So in overall performance, I gave them a 4. And then for reputation, I gave them a 4 as well. They've grown massively in the past couple years, which is really impressive, especially given the tough fundraising environment back around COVID times. Given that they're able to fundraise so much, I think it's a strong sign that LPs really have a lot of conviction in them. And rapidly scaling as a PE firm also means that there's a lot of room for promotions. So it could mean that this is a great firm to work at right now if you're currently interested / recruiting for private equity. And so in total, they get a score of 13, which lands them in the A tier. Next up, we have Platinum Equity, which we're going to put in the C tier, and they are based in Beverly Hills. They focus on buying underperforming assets, often from Fortune 500 companies, through carve-outs and distressed deals. They're known for their M&A and O, mergers, acquisitions, and operations turnaround approach, and also having a business model where they have a separate team screen for deals, which are passed over to the execution team, which is great if you're on the execution team and you want to only focus on execution. For fundraising, they recently raised $12.6 billion in 2024. And so I gave them a 4, and they exceeded their 2019 fund by 26%. So overall, pretty strong. In terms of performance, I gave them a 3. Due to the nature of their investments, they've had a lot of zeros that are made up for a lot of big winners. So they've had about 10% IRR for their 2021 fund, and then about 18% from their 2019 fund. So not terrible, especially if you kind of discount the 2021 fund, but not as strong as the other ones on the list. And then for overall reputation, I gave them a 2. They're known for having a very sweaty and tough culture, and they may be doing something right because their latest fundraising is going well, but they're known to also be struggling with exiting a lot of its recent investments due to deteriorating financial performance and high debt loads. So this company is more like a venture capital / growth equity firm in a sense, where their investments, a lot of them could go to zero, but a lot of them can be home run hits. So anyway, that's kind of the overall picture for the firm right now. And with a total score of 9, they land in the C tier. Next on the list, we have Roark, which I am putting in the D tier. Another very interesting private equity firm. They're based in Atlanta, and they actually specialize in buyouts of franchise-driven and multi-unit businesses in restaurant, retail, and consumer industries. So they've invested in companies like Subway and Dunkin' Donuts. I gave them a 2 for fundraising because they're in the process of raising $5 billion, which is not really as large as some of the other firms on this list. And then for performance, I gave them a 2 because they used to kind of have top quartile-ish returns, but more recently, their funds have been a lot more average in terms of their performance. And then for reputation, I gave them a 2 as well. They have a very unique strategy. And in the space, if you're super interested in restaurants, retail, consumer, franchises, then they probably are one of your top picks. But overall, it's pretty tough to generate extraordinary returns with their strategy. I gave them a 2. With a total score of 6, that lands them in the D tier. Next on the list, we have TA Associates, which is the first firm in the S tier. They're based in Boston, and they're focused a little bit more on growth rather than purely being a buyout firm. But they do invest similarly to later stage buyout shops by buying majority control and using leverage. They're also known to use a lot of strategic acquisitions and roll-up strategies for growth for their firms. They recently raised $16.5 billion in 2023, so they were oversubscribed and exceeded their initial target. So really, really strong fundraising for the firm, so it was obvious to give them a 5, kind of in mega fund territory. They're also historically very strong in terms of performance, so I gave them a 5 as well. They're number 2 on HEC Dow Jones list in terms of best returning funds. And then their recent fund in 2021, a little bit questionable in terms of how things are performing, but given it is a recent fund, we have to give some time to see how it plays out. And then their previous funds have been around 20 to 30% plus IRR, so just really, really strong in general. And then for reputation, I gave them a 4. They have a general, just really strong reputation and exited extremely well during the bull market. And so things are just looking pretty good for the firm overall right now in terms of sentiment. One thing that maybe junior associates don't really enjoy is that the firm is known to do a little bit more sourcing. And so that's something that you may not really like as a more junior private equity investor. But with that said, overall gave them a score of 14, which lands them in the S tier. Next on the list, we have Veritas Capital, which I will put in the A tier. And the company is based in New York and used to focus more on government-related deals like aerospace, but now a good portion is on tech and healthcare, and their bread and butter is on healthcare tech. They are in the process of raising $13.4 billion for a new fund, $2.5 billion more than their last fund in 2022. So I gave them a 4 for fundraising. And then in terms of performance, I gave them a 5 because they're known for having just really, really strong returns and ranked number 1 for multiple years in a row in the 2010s. So for that reason, I gave them a 5. And then in terms of overall reputation, I gave them a 4. They have a very sweaty reputation, a lot of hardos with kind of ruthless culture, but full of just really, really smart people. And it's just a well-respected firm. Also would say they have one of the best AUM to IP ratios as well. So it's great for senior investors. And so for those reasons, overall gave them a score of 13, which lands them in the A tier. Last but not least on the list, we have Warburg Pincus, which I kind of think is one of the cooler names for a private equity firm. We're putting them in the S tier, and they're a firm based in New York. Their DNA is in growth investments, but they also do some buyouts. And they invest a lot in tech, healthcare, financial services, and industrials. They're unique in that they primarily invest out of one single big fund across all geographies and strategies, as opposed to other firms that have a fund that may be focused on a single strategy or geography. They raised $17.3 billion in 2023, the largest in the firm's history, and the fund was oversubscribed as well. Definitely basically like mega fund territory. So I gave fundraising a 5 for them. And then for returns, they usually provide very solid returns that are not extraordinary, but very reliable. So I gave them a 4 for performance. And then for reputation, I gave them a 5. They're highly respected and have a really, really strong reputation, very strong legacy brand as well, and high compensation in the market as well. They're known for having a very intense and sweaty culture, but usually pretty worth it if you're interested in PE. And so for Warburg, I gave them a score of 14, which lands them in the S tier. All right, so that concludes the rankings for the middle market private equity firms. My goal with this was for you to learn a lot about the actual firms as opposed to actually caring too much about the actual private equity firms on the list and what the rankings are, because at the end of the day, all of these are really great firms. If you get an offer from any of them, then you should probably take it. And with that said, if you have any other questions or comments, something I missed about these firms, please do let me know in the comments. I'm always trying to learn more. And thank you all so much for watching as usual. Hope to catch you all in the next video.